Japan's lost decade didn't begin with a simple market downturn. It began with an illusion that seemed unstoppable and a hidden system that made the collapse inevitable. In the 1980s, Japan became the wealthiest nation on Earth. Its companies dominated global manufacturing, electronics, autos, and exports. Analysts predicted it would overtake the United States. At the peak, Japan controlled nearly half of the world's equity wealth, and global investors believed it was building the future. But beneath the surface, Japan was laying the foundation for one of the most destructive asset bubbles in modern history. The country's rise wasn't powered purely by innovation. It was powered by an unprecedented explosion of credit fueled by three powerful institutions: the Ministry of Finance, the Bank of Japan, and the corporate megastructures known as the Keiretsu. These groups together created a closed-loop system of lending, investing, and self-reinforcement that made the bubble far beyond any rational measure. The turning point came in 1985 with the Plaza Accord. As part of a global effort to stabilize currency markets, Japan agreed to strengthen the yen. But a stronger yen made Japanese exports far more expensive. Factories slowed. Profits shrank. The government panicked. To counter the slowdown, the Bank of Japan slashed interest rates, unleashing a flood of cheap credit into the economy. Banks, eager to keep growth alive, pushed loans aggressively onto households, corporations, and investors. Land became the ultimate form of collateral, and its value soared, not because of demand, but because the system needed it to rise. Homes were bought and resold like lottery tickets. Office buildings became speculative chips. Companies borrowed not for expansion, but to buy back their own stock. Ordinary families took on debt believing land prices could never fall. Japan's entire economic identity became tied to the belief that prices only went one way, up. And because land served as collateral for nearly every major loan, rising prices justified even larger loans, creating a self-reinforcing cycle detached from real income, real productivity, or real demand. By the late 1980s, the bubble had become a monster. Every metric: real estate, equities, corporate leverage, had detached from reality. Yet, inside the system, the warning signs were ignored. Banks believed the government would intervene if anything went wrong. The Ministry of Finance believed markets needed just a little more time. Corporations believed the boom would continue indefinitely. No one wanted to be the first to admit the truth. The foundation of Japan's prosperity was built on debt piled on top of debt. The stage was set for a collapse that would not only destroy trillions in wealth, but freeze the country's growth for an entire generation and reshape global macroeconomic policy for decades. By 1986, Japan's low-interest rate experiment had turned into a historic credit tidal wave. Cheap money flooded the economy, and banks aggressively pushed loans onto corporations, families, and small businesses. The logic became self-reinforcing: borrow more, buy more, and assume the future would always be richer than the present. This overwhelming optimism marked the beginning of Japan's most dangerous financial phase. Real estate became the epicenter of the mania. Land prices climbed so quickly that properties were bought and resold within days, with little concern for income, rental yield, or any rational valuation. Office buildings were no longer places of business, but speculative assets traded like stocks. Ordinary families, terrified of being priced out forever, borrowed far beyond their income to secure homes. Apartments functioned like lottery tickets. Owning land felt like a guaranteed path to wealth. Companies used debt to buy their own stock, pushing valuations further into fantasy territory. It was financial engineering at a national scale. Profits were irrelevant as long as credit was available. By 1989, Japan had entered the final, most dangerous stage of the bubble. A handful of economists quietly warned senior officials that if the system cracked, Japan could lose decades of growth. But no one wanted to pull the brakes. The bubble had become too large, too politically sensitive, and too woven into national identity to confront honestly. This is where the three hidden actors took center stage. Hidden actor number 1, the banks. Banks became the primary creators of the bubble, issuing loans backed by ever-rising land prices. Land values justified bigger loans. Bigger loans justified higher land prices. And the cycle repeated. Banks transformed into bubble machines, expanding credit far beyond what the underlying economy could support. Hidden actor number 2, the Ministry of Finance. The ministry understood the risks but chose paralysis. Rather than intervening decisively, they allowed markets to run a little longer, hoping the bubble might somehow stabilize itself. That hesitation would eventually cost Japan 30 years of growth. Hidden actor number 3, the Keiretsu conglomerates. These corporate groups, deeply intertwined with banks, demanded looser lending standards to finance aggressive expansion. Banks complied because they believed the government would step in if anything went wrong. Leverage became the silent engine powering the entire system. By late 1989, Japan existed inside a financial hallucination. Land prices no longer reflected economic reality. Stocks were priced on hope, not cash flow. Borrowers took loans on the belief that land values alone. Japan's bubble was not accidental. It was structurally wired to explode. Its entire financial system depended on one assumption: land prices would never fall. Land became the ultimate collateral. Banks lent money against it. Borrowers bought more land with it. And rising prices justified even larger loans. Income didn't matter. Cash flow didn't matter. The only thing that mattered was the rising value of the asset being pledged. This created a self-reinforcing illusion of wealth that replaced genuine economic growth. As credit expanded uncontrollably, asset speculation spread through every corner of Japanese society. Farmers mortgaged fields to buy office towers. Teachers bought apartments. Hairdressers bought golf courses. Everyone became a leveraged investor because borrowing was easier and more profitable than saving. The system stopped functioning as an economy and became a nationwide speculation engine. By late 1989, the Bank of Japan realized the bubble had grown monstrous. In a belated attempt to control the mania, it raised interest rates sharply. But after years of free money, even a modest tightening caused profound stress. Borrowers suddenly struggled to make payments. Debt loads became unbearable. The psychological shock was immediate. The magic died. Behind the scenes, the Ministry of Finance and major corporations tried to delay the collapse. Banks were discouraged from admitting losses. Companies hid bad debts through cross-shareholding. Political leaders hoped the bubble could soft land. But reality didn't negotiate. The rise in rates triggered a cascade. Borrowers defaulted. Land values fell. Collateral shrank. Banks panicked. Lending froze. And the cycle reversed with incredible speed. Land prices crashed first. Properties once valued in the billions lost half their worth. Since land backed most of Japan's loans, the banking system's balance sheets collapsed. Then stocks followed. The Nikkei fell from almost 39,000 yen 1989-15 in 2 years. Trillions in wealth evaporated. Once the correction started, every pillar of the economy broke in sequence. Businesses reliant on cheap loans collapsed. Banks stopped lending. Unemployment rose. And thousands of deeply indebted companies were kept alive artificially through endless refinancing, creating the infamous zombie companies that would haunt Japan for decades. The bubble had become a monster on the way up. Now it became a wrecking ball on the way down.
By 1992, the Japanese bubble had transformed from an overheated boom into a historic systemic collapse. What made this crash so devastating wasn't just the loss of wealth, it was that the entire economy had been built on top of inflated collateral. When land and stocks began falling, the foundations of Japan's financial system simply disintegrated. Bankruptcies surged. Loans failed. Companies that had seemed invincible suddenly found themselves insolvent. But the deepest damage was psychological. Japan realized it had no idea what anything was truly worth. For years, inflated prices had replaced genuine fundamentals. When the illusion vanished, the country was left staring into an economic void. The banking system was the first to break. Banks didn't know which loans on their books were viable and which were worthless. Fearing total insolvency, they froze credit across the economy. Lending the oxygen of Japanese businesses stopped instantly. Home buyers disappeared, investment halted, and corporations suffocated as their access to capital vanished. A nation addicted to abundant liquidity now faced total drought. The government responded with desperation. Across the 1990s, it launched 11 massive stimulus packages, each promising revival. None worked. The economy was too damaged. Stimulus money flowed into holes instead of growth. Corporate Japan, once the pride of the world, was exposed. Families faced their own crisis. Many had borrowed heavily to buy homes at peak prices. Now their properties were worth far less than their mortgages. Savings evaporated. Consumption collapsed. The Japanese middle class, once a symbol of prosperity, shifted from upward ambition to survival mode. Then came the deeper crash, the emotional one. Young people delayed marriage, children, and careers. Companies froze hiring. The collective confidence that powered Japan's rise dissolved into uncertainty. For the first time, the future felt smaller than the past. Yet in this turmoil, a surprising group emerged victorious. Those who held large cash reserves, both individuals and corporations, became the unexpected winners. With asset prices collapsing, they purchased land, companies, and real estate at historic discounts. A new breed of corporate predator appeared. Firms with little debt and large cash positions swept across industries, acquiring weakened rivals and amassing influence. Foreign investors, especially from the U.S. and Europe, joined the hunt, buying office towers, hotels, and entire divisions of Japanese companies at bargain prices. The great irony of the collapse is that the survivors were not the most innovative or visionary. They were simply the least leveraged. In a system built on debt, the only true advantage belonged to those who resisted the mania. When the bubble burst, conservatism, not ambition, became the winning strategy.
Japan's crash didn't end with the initial collapse. It marked the beginning of an economic era unlike anything experienced by a major advanced nation. By the mid-1990s, Japan entered a long period of stagnation where growth flatlined, inflation disappeared, and interest rates fell toward zero. This was the birth of the world's first major zero-rate economy. Years before the West followed the same path. Japan wasn't recovering, it was drifting. Deflation became the country's most persistent enemy. Prices slid downward year after year. Consumers delayed spending, expecting goods to be cheaper tomorrow. Businesses postponed investment, uncertain about future demand. The entire economy slowed to a crawl, trapped in a loop where pessimism suppressed growth, and weak growth reinforced pessimism. This created a lost generation. Young workers entering the job market during the 1990s faced hiring freezes, low wages, and stalled careers. Lifetime employment, a core pillar of Japanese corporate culture, fractured. For millions, upward mobility vanished. The country didn't just lose wealth. It lost momentum, optimism, and the intergenerational confidence that had powered its rise. Meanwhile, Japan's corporate landscape evolved into a zombie economy. Thousands of unprofitable companies survived only because banks continued lending to them, afraid to recognize losses. Instead of allowing creative destruction, the system preserved corporate fossils. Capital was trapped in failing firms. Productivity stagnated, and innovation slowed. The result, decades of weak growth and chronic underperformance. The central lesson of Japan's collapse is simple. A bubble destroys more than capital it destroys belief. Confidence is the one economic ingredient that no central bank can print. And once lost, it can take generations to rebuild. Modern parallels are now striking. In the United States, asset prices, corporate leverage, and market dependence on low interest rates echo Japan's pre-crisis conditions. A tech-driven boom resembles the 1980s Japanese corporate dominance. Europe faces its own warnings: aging demographics, low productivity, and decades of slow growth eerily mirror Japan's trajectory. Many European companies rely on cheap financing to survive rather than innovate, setting the stage for a European version of the zombie economy. Across the world, heavily leveraged markets reveal familiar danger signs: soaring real estate prices, record household debt, and corporate buybacks fueled by borrowed money. These behaviors follow the playbook Japan routinely now performed on a global stage. The winners of the next global downturn will mirror Japan's winners, those who stay unleveraged, hold cash, and buy assets when forced sellers dominate the market. In a debt-fueled world, discipline, not leverage, becomes the ultimate edge. Japan's lost decade is more than an economic story. It's a mirror that reveals how societies repeatedly fall into the same psychological traps. The final chapter of this narrative asks not just what happened to Japan, but what it teaches us about human behavior in financial markets. Japan's collapse exposed a universal truth: economies fail not only because of numbers, but because of beliefs. Japan's bubble was fueled by confidence, and its collapse was deepened by the loss of that confidence. Once shattered, belief in the future evaporated. This wasn't just a financial downturn, it was a crisis of identity. The country that once saw itself as the world's next superpower now questioned its place in the global order. The psychological wound left by the lost decade shaped Japanese society for generations. The philosophical question that emerges is simple yet haunting. If every generation creates its own bubble, why do we assume we will escape the fate of those who came before? History shows that financial manias rise from the same ingredients: optimism, leverage, complacency, political hesitation, and burst for the same reasons. Japan was the world's strongest economy when its bubble burst. If it can happen there, it can happen anywhere. Japan's story didn't just influence its own future, it reshaped global finance. The zero interest rate policies and quantitative easing strategies that became standard tools for central banks worldwide were pioneered in Japan during the 1990s as emergency measures. What began as temporary crisis responses eventually became the blueprint for modern economic management. In a sense, the world didn't reject Japan's example, it copied it. This raises the episode's soft cliffhanger. Is the world now living through its own version of 1989? Asset prices in many countries look stretched. Corporate debt has exploded. Entire industries rely on cheap financing to survive. Real estate markets show signs of speculative excess. Technology stocks dominate global wealth in ways reminiscent of Japan's karetsu dominance. The patterns are familiar. And so are the dangers. The challenge to today's investor is not whether a downturn will come, but whether they are prepared for a prolonged stagnation rather than a sharp crash. The next lost decade may not look like Japan's, but the structural forces driving bubbles and collapses haven't changed. Those who survive and thrive will be the ones who stay unleveraged, maintain liquidity, and deploy capital when forced sellers reappear. The episode ends by pointing toward the next chapter: the rise of a modern financial superstructure built on levels of leverage, shadow banking, and liquidity dependence that dwarf Japan's 1980s system. If Japan was the warning, what's coming next may be far more dangerous. Because history doesn't repeat, but it whispers. And today, that whisper sounds a lot like Japan's. Japan's lost decade wasn't just an economic disaster. It was a global warning shot that the world ignored. In this cinematic deep dive, We uncover the hidden blueprint of the 1980s Japanese asset bubble, the quiet policy mistakes that detonated it, and the chilling way the same patterns are resurfacing in today's markets. At its peak, Japan was the richest nation on earth. Tokyo real estate was worth more than entire countries. The Nikkei dominated global equity wealth. And then, almost overnight, the system collapsed. But this wasn't random. It wasn't fate. It wasn't inevitable. It was engineered. Thanks for watching Japan's Lost Decade, the bubble that still haunts the world economy. If this episode blew your mind even a little, smash that like button. Share this video with someone who loves crazy finance stories. And hit subscribe so you never miss the next big reveal on Finance Arcana. We've got more wild episodes coming in our Forbidden History series. You won't want to miss them.